So a lot of the smartest money in America is sort of facing off on one of the big companies here, Hewlett-Packard. Rob, you've looked at both sides. You've got on one side Ralph Whitworth of Relational Investor, who's also on the board of the company, who's kind of got the bull case for it. And then the other side is Jim Chanos, the legendary short seller, who's got a short position on the company. So what's your sense of these two guys?
Well, they've got two things. I mean, for the activists like Ralph Whitworth, I mean, he's saying, okay, this company's got some problems. Namely, it's done a huge history of acquisitions which are terrible.
Right.
And the company's spent about $60 billion on acquisitions, I think it is, over the past decade. The company's worth about half of that now. The
most recent of which was Autonomy in the UK, which looks to have been a huge overpayment.
Yeah, and the problem is it's like typical company that's messing up.
Right.
I mean, they had all these management problems. They fired 3 of their past 4 CEOs.
Right. So Autonomy was done under the
Apoteca, the last CEO.
And now you have, of course, Meg Whitman running.
And so, you know, if you think about the typical activists, they'll come in and they'll say, okay, what are we going to do? We're going to stop digging, you know, so stop doing stupid acquisitions, basically make sure the company spends a bit more on R&D, make sure and maybe, you know, you can look at the company and maybe spin off parts of it. It'll take a long time for this to bear fruit. But
you have but their core businesses are declining, many of them. So
yeah, that's the short critique.
Right.
You know, and the longs do have another point in their favor in that the stock is incredibly cheap. It trades about 4 times earnings. The shorts are looking, yeah, that's the story. The shorts are looking at it and saying, okay, this company, you know, they sell PCs and printers. I mean, you know, these are 2 markets.
Dodo bird.
Exactly, a dodo bird business. You know,
yeah.
if you've got a tablet, you don't buy a PC. If you have a tablet, you probably don't print out anything either. You don't print very much. And so they're looking at this and saying this company, they've got a history of messing up just repeatedly, and the declining earnings, and so, you know, why would you want to own this? And also, if you look at the accounting, there's some funnies in it, so it's questionable, you know, how
but of course,
strong
the bull
this company
case
is.
They can meet in one respect, and if you believe that there's enough cash flow from some of these businesses to basically run them for cash, not invest in them, to run them almost like a sort of
annuity or something.
Yeah, I mean, isn't there? You can look at the long-term value of those cash flows and to decide that the net present value is
that could be the case, you know, like I said, with trading at 4 times earnings. However, with tech companies, that's always a very dangerous thing, because these things tend to, you know, they're going and all of a sudden they fall off a cliff. Like Kodak, for instance, you know,
HP
a company you did not want to buy.
That is a harsh inference. All right, well, thank you very much. We'll be back with more Breaking Views tomorrow.